A 1035 exchange can often make IUL owners far more money. In this educational episode, I'm going to address the question, what is a 1035 tax-free exchange with regard to life insurance? Get ready. I'm going to teach you some things that most insurance agents don't understand. So I'm Doug Andrew. I've been helping people optimize assets, minimize taxes, and empower their authentic wealth now for nearly 5 decades. And in doing that, people view me as a financial strategist, retirement planning specialist. And if you've watched very many of my educational videos or read any of the dozen books that I've been honored to have authored thus far, you'll understand that my favorite financial vehicle to help people accumulate their money tax-free and then be able to access that money totally income tax-free for their business, for working capital, for college funding. But then at the end of the day, most people use it for retirement, because it knocks the socks off of most IRAs and 401ks. You only have to earn a return like I have, averaging 11% to net 10% cash on cash, retroactive back to day one. If you structure the IUL correctly, you fund it properly, and you rebalance. So if you don't know what I'm talking about, you can watch some of the other episodes to understand this. But then people say, well, when should I consider exchanging it for a new policy? Now, this is a section of the Internal Revenue Code, Section 1035, that if you have an older life insurance policy, and I don't want to encourage you just to drop an old policy, because sometimes you can perfect it, you can utilize it and just change the structure a little bit so it will perform better. But many times when I would meet with clients and I could see that the former insurance agent didn't really know what they were doing when they structured the insurance policy, they had more death benefit than they needed. And so I might be able to go into the old policy and just lower down the insurance as long as I didn't violate the TAMRA and tweak it so that it could earn a better rate of return. So at the end of the day, the net rate of return was within 1% of the gross rate of return. But sometimes I looked and I went, we're going to be lucky to gross 8. And yeah, I can tweak this to net 7 because if you earned 8 the way this former agent structured it, you're only going to net 4 or 5. So I can tweak an older policy. But then if I know that there's newer IUL policies with newer features where you could earn maybe 10 or 11 like I have, instead of tweaking the old one to perform at 8 and net 7, it would be better to exchange it for a new one where you can rebalance and earn 11 and net 10, or use some multipliers, or maybe the new policy has the option for a 1-year point-to-point with no cap, which is what made many of our clients 61.33% returns during COVID-19 from March of 2020 to March of 2021. So maybe a new policy will have features or index options or linking methods or borrowing features that the old policy doesn't have. So it may behoove you to let go of the old policy, but before you just let it go, see, if you just let it lapse or you just cancel it and you take your cash surrender value, then if you actually made money in it, you're going to have to pay tax on any money you get out of canceling the policy over and above the premiums you paid into it. You don't want to do that. You don't want to trigger unnecessary tax. So let's say the old policy that you have, you put in, $80,000 and it grew to $100,000. It wasn't structured very well, but at least it's grown some. So it's worth $100,000 and you put in $80,000. Well, if you just cancel it and you pull out $100,000, you're going to have to pay tax on the $20,000 that it's worth over and above what you put into it. That's called your basis. So you don't want to do that. You can tax-free exchange it and avoid paying tax on the amount. Okay. Now, that's the first thing you need to understand. So in the Internal Revenue Code, the IRS allows you to exchange tax-free the money in an old insurance policy, a permanent insurance policy that has cash value, and be able to transfer it into a new insurance policy without having to pay any tax. The money has to go straight from the old insurance company, the company that has the old policy, in a 1035 exchange. And sometimes they drag their feet, and it may take, 60 days or 90 days, but it's worth it to do a 1035 exchange. There's a form you fill out. You notify the old company, and they may try to get you to not do that because they want to preserve the business, but they're used to this. People do it all the time. And so they send a check to the new insurance company on the form, and it is deposited into the new insurance policy, the account number, the policy number, but it's done without you getting the money. So if you take receipt of the money, it's not like a 1031 exchange on real estate where you can take receipt of the money and you got, 60 days or 90 days to hurry and go buy another piece of real estate and be able to get a step up in basis. No, you have to have the insurance company that had the older policy transfer the money to the new policy. So let's go back to this example. Let's say you had a policy that you put in $80,000 and, it grew to $100,000. It has $100,000 of cash value. And you want to get a newer, nicer, better policy, and you have some additional money. And so you want to be able to put in another $200,000 in addition to the $100,000 of cash value that's in the old policy. So the new IUL policy has a guideline single premium, is what we call it. Let's say of $300,000. Well, what you can do is transfer the $100,000 of cash value under Section 1035 into the new one, and you hit the ground running with $100,000 into the new policy. But that's as far as most agents ever get to, is they say, oh yeah, we'll do a 1035 exchange. Let's take the $100,000 out of the old policy, put it in the new one, and then we'll fund the other $200,000. But now you're subject to the TAMRA tax citation, where the $200,000 has to be spread out over, let's say, 5 years. So $200,000 over 5 years, you can only put in $40,000 a year, and maybe that's okay. Maybe that's all the money you have. But if you have $200,000 of cash and you want to get it in there as soon as possible, because the faster you get it in there, the faster it's going to grow. And so this is what a lot of agents don't understand. Before you do a 1035 exchange, if you're going to try to get the money and the client has the money and you want to get it into the new policy as soon as possible, but TAMRA won't let you, find out what the maximum amount of room under TEFRA and DEFRA is under the old policy, the guideline single premium. So that means, let's say the former policy, you could have put in up to $200,000 in your lifetime without violating the definition of tax-free insurance under TEFRA and DEFRA tax citations. But you only have $100,000 in there. Well, you can add another $100,000 to the old policy. If there's room for another $100,000 that you never used, use it. You pay $100,000 to the old policy. Now, there might be a premium load on that, but that's going to be small compared to how much faster your money's going to grow when you get it over to the new policy. Even if the new policy has a premium load, don't worry about the premium loads, because you put $100,000 into the old policy, now it has $200,000, then do the 1035 exchange. Why? Because the $200,000 can go into the new policy and you don't have to spread that out over 5 payments. The $200,000 hits the ground running. Let's say the old policy has $300,000 of room. You could put the whole additional $200,000 into that and then do a 1035 of the $300,000 of the new one. You don't even have to wait 5 years. You hit the ground running and you maximum fund the new one right off the bat. See, it's way better to have $300,000 working for you than to only put in $200,000, and then the last $100,000 you can only put in $20,000 a year to comply with TAMRA. Does this make sense? The faster you can maximum fund it, the better off you're going to be, and you will make enough interest to way more than cover the premium load of putting money in the old policy and then the premium load of transferring it into the new policy. People get uptight about premium loads. No, those will be covered pretty quick with the interest you're earning on maximum funding the new policy sooner than later. So that's called a 1035 tax-free exchange. Make sure if you're going to do it, that you do it with an agent who is savvy, that understands 1035 exchanges. Don't do it with an agent that goes, oh, we'll just cancel it and transfer it over. You may have to pay unnecessary tax unless the cash value is less than what you put in there. But if you're going to put in some lump sums, you may want to take advantage of throwing that money into the old policy, then doing the 1035 exchange so you don't have to spread out this new money over 5 payments. You don't have to park it somewhere for 5 years while you're waiting to comply with TAMRA. You comply with TAMRA because you've already complied under the old policy. You're grandfathered. Does that make sense? So I hope this has been helpful to you. If you want to learn more about max-funded indexed universal life and how to do it correctly and fund it properly, and when it's done that way, it's deemed a laser fund. Laser is an acronym that I've used for years that stands for Liquid Asset Safely Earning Returns. And so this is my 11th book. It's been flying off of our warehouse shelves. You can go to Amazon and buy it for $20, and you'll probably pay another $10 for shipping and handling. And if you do that, thank you. But you don't need to do that. I'll gift you a copy of this book free. To claim your free copy, you go to laserfund.com, laserfund.com, or click on the link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book and fire out a hard copy to you via priority mail. When you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's audio and video formats. Check out the educational webinars we do on a regular basis. They're free, no charge. You can even schedule an appointment with an IUL professional that I oversee that has had to pass a proficiency exam that already understands all of these nuances like 1035 exchanges and what I just explained in this video. So hopefully this video was educational for you. Claim your copy of this book, whether you're an IUL professional. But if you are a consumer and you want to make sure it's done correctly, learn, and there's questions in here that you can ask an IUL agent to see if they really do understand it. I don't want you to make any mistakes or kick yourself because you didn't make sure it was done properly, especially if you're exchanging an old insurance policy for a new one and you want to be grandfathered tax-free and hit the ground running with as much money as you can into that new policy if you've been grandfathering room under the old policy.